If you earn a high income, there's a good chance someone told you that you cannot use a Roth. And that's only partially true. And that partial truth might be costing you and your family a fortune. Today, we're going to walk you through every door that gets money into a Roth account, including a few people don't even know exist.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions. So let's start with why this matters. A Roth is one of the only accounts in the entire tax code where your money not only grows tax-free, it comes out tax-free. Not tax-deferred, not tax-reduced, tax-free. And if you leave it to your kids, they receive it tax-free. So the obvious question is, why wouldn't you want as much money as possible in an account like that? And the answer most people get is, you make too much. You're not allowed. That's an incomplete answer, and today we're going to fill in the rest.
At the most basic level, there are two ways to get money into a Roth. Number one, you contribute directly. This is straightforward. You put money in, it grows tax-free, you take it out tax-free, so long as you comply with the rules, which you must be age 59 and a half, and the account has to have been open for 5 years. But there are income limits to Roth contributions, at least Roth IRA contributions. If you earn above a certain threshold, the IRS says you can't contribute directly into a Roth, and that's where most people stop. They hear you can't, and they move on. Number two, you convert. You take money from a traditional IRA or 401k, and you move it into a Roth. You pay taxes on that conversion now, but after that, all of that money grows tax-free forever. And here's the key. There are no income limits, right? None. No income limits on Roth conversions. It doesn't matter if you earned $150,000 or $5 million. The conversion path is open to everyone.
If the front door is locked, the side door is wide open, and it's completely legal, built right into the tax code. The IRS knows it. Your CPA knows it. Well, at least they should. The question is whether anyone has ever talked you through it.
So let's walk through the doors, and there are more of them than you might think. The first one is what we call a Backdoor Roth IRA, and despite its name, there's nothing shady about it. In fact, every year every time the government recently has talked about changing the tax laws, it's one of the things that they have agreed to continue to allow. So here's how it works. You make a contribution into a traditional IRA, but you don't take a tax deduction on it. It's an after-tax, non-deductible IRA contribution. Then, the very next day, you convert that traditional IRA into a Roth. That's it. Since the money went in after tax, there's almost no tax on the conversion. You may have a couple dollars of interest from the day or two that was in there, but it's like putting money directly into a Roth, just one day removed.
Now, there's a catch. If you already have money sitting in a traditional IRA, the math gets complicated. There's something called the pro-rata rule that can create a tax liability you didn't expect. But here's why a lot of people don't realize. Money in a 401k doesn't count toward the rule. So if all of your retirement savings actually in a 401k and you don't have a traditional IRA balance, the Backdoor Roth is clean and simple. And for clients who do have a small traditional IRA, sometimes the smartest move is to convert that balance first, clear it out, and then the backdoor path is wide open going forward. The details matter here. This is one where you want someone looking at your specific numbers. If you're realizing there are strategies in the tax code that nobody explained to you, subscribe. This will not be the last door nobody told you about. There are more.
Door number two, the Roth 401k. Now, not every employer offers this. My daughter's company didn't allow it until recently, and pretty much the first week they were available, we went on and had her sign up for it. But more and more plans are adding it as an option every day. They're becoming more and more popular. And here's the thing. Switching is usually simple. You log into your plan and change where your contributions go. Instead of 3%, 5%, 10% of your salary going into traditional, you just put a zero there and put that number into the Roth box. You don't have to do it all, but it's the same money going in. It's just a different tax treatment on the back end. It may affect your paycheck when you do it, so you'll have to work the numbers. But the trade-off is that you don't get a tax deduction today, but the money grows tax-free forever. And if you think about all these people with millions and millions of dollars of retirement plans, most of who didn't have Roth IRA, Roth 401k rules available, I mean, you ask them if they would have done it, and they would have said overwhelming yes. Again, the money grows tax-free. It comes out tax-free in retirement. For somebody that believes tax rates might be higher down the road, and we are two of them, we think the trade-off starts to look really, really attractive.
And then there's door number 3. This one is what Paul calls the unicorn. It's called a Mega Backdoor Roth 401k. Here's how it works. Once you've maxed out your regular 401k contributions and your employer has put in their match, some plans, not all, but some allow you to make additional after-tax contributions on top of that. And the government allows you to roll that extra money directly out of your 401k into your Roth IRA where it grows tax-free.
Right? So instead of it being that after-tax money growing at a tax-deferred rate, you take it out, put it in the Roth, and it grows at a tax-free rate.
Yeah, it's a great tool.
So let's put some numbers to this so we can see why this matters. The total amount that can go into a retirement plan in a given year between your contributions, your employer's match, and any after-tax additions is significant. It's over $70,000 right now. We're talking about the ability to put substantially more into tax-advantaged accounts than most people realize. So you max out your 401k contributions, your employer kicks in the match, that's a good chunk, but it's not the limit. If your plan allows it, and your plan has to allow this, the gap between what you've put in and the total plan limit, that's how much room you have for additional after-tax contributions that could be converted to Roth, and that's, in essence, the Mega Backdoor Roth 401k. You think about it, if you start doing that every year for 5 years, 10 years, 15 years, and your Roth, you look at when you're 65, and it's a substantial amount of money, all of it tax-free for retirement.
The reason most people have never heard of this is because not every plan allows it. It tends to be larger employers with more robust plans that allow it. But if yours does, and you're not using it, that's an opportunity sitting right on the table. Now, the fourth path is the one that people think of first, the straight Roth conversion. You take a certain amount from your traditional IRA, 10, 50, 100,000, and you convert it to Roth. You pay income tax on that amount in the year you convert.
And that's where it becomes a puzzle. Be aware that everybody's different. And the reason it's a puzzle, it's because the amount you convert lands on top of your other income. So you need to keep good records so you have an idea as to where you're going to be. Then you have to decide you have to figure out which tax bracket you're in, and then whether it makes sense to you for you to pay that tax bracket to never have to pay the taxes again. We've talked about tax rates being at historic lows. The other thing you have to think about is Medicare surcharges. So if you're 63 or older, these might affect what Medicare charges you when you're 65 or older. You have to think about estimated payments so you don't get hit with penalties. And again, as we said before, every client's different. Whether your brother does or your sister, your neighbor, your best friend, everybody's different. We find is the art is in the execution, and that's figuring out how much to convert each year, over how many years, to get the most money to Roth at the lowest tax cost. Some clients set a 3-year timeline, some set a 5-year timeline. But what we find is once you get going, people start to notice it more and it becomes more of a priority. First thing, how big is the problem? How many dollars do we ultimately need to move from tax deferred to tax free? And then we map out a game plan for you to do it. And that's where your personal CFO comes into play.
So let's bring this together. If you've been told you can't use a Roth because you earn too much, that's the wrong answer. Front door might be locked, but there may be 3 other doors that are wide open. The Backdoor Roth IRA for high earners who can't contribute directly, the Roth 401k if your employer offers it, many now do, and then the Mega Backdoor Roth 401k, the one most people have never heard of. And Roth conversions, moving existing retirement money into a tax-free account strategically over time.
With an emphasis on strategically. Most people don't have a Roth problem. Quite frankly, they have a knowledge problem. They're just not informed of all the different ways to get money into a Roth. And once you see it, you can unsee it. The question shifts from, can I use a Roth, to how fast can we get money in? The door to the Roth isn't closed. It just requires a strategy.
So if you're looking at your retirement accounts right now and thinking, how much of this should be in a Roth? And how do I get it there without making a costly mistake? That's exactly the kind of conversation we have with families every day. Click the link below to schedule a conversation. Because investing is the easy part. Getting the tax structure right around it, that's hard.
And if you're now thinking about your tax-deferred accounts differently, wondering whether all those years of deferring into your 401k were really the best move? Here's a video you need to watch now. It explains why your tax refund might be the worst measure of your tax strategy and what the informed are doing instead to lower their family's lifetime income tax bill. Click here and watch it now.